Hello, everyone. Let's go over chapters 1 and 2, lecture part 1. Now, our parts 2 and 3, make sure to check those out as well. Let's get into it. Accounting. What is accounting? Well, in a nutshell, it's the financial story of a person or organization. So, again, it's the story of a person or an organization, but it's their financial story. I like to say that accounting is the language of business. It's how businesses communicate with one another. And not just businesses, but you'll come to find out that everyone needs accounting in some form or another. And it's an important language to know. And hopefully you treat it like that because accounting is not math. Accounting is more similar to learning a language. What's the purpose of accounting? Think of a robot that makes coffee. It's an awesome robot, makes coffee. And in reality, it's pretty simple because you turn it on and it makes coffee for you. But the robot, let's assume in this case, represents accounting. The robot itself, there's a lot of things going on inside it to make it work. In accounting, those on the left right there, those are the nuts and bolts which make the robot work or which makes up the robot. Those things we're going to learn throughout the semester. So the robot is accounting, makes coffee. And inside the robot, it analyzes, records, classifies, and summarizes financial information. Why are we doing that? Or why does accounting do that? Well, we need these things called financial statements. It's on the coffee that he's holding. Those financial statements are very, very important to everyone. Everyone that cares about the financial standing of a person or a business. Because it's a report to show how they're doing. And the report gets interpreted so people can make important decisions. Everyone from the owners, managers, employees, investors, the government, competitors, creditors, suppliers. Everyone uses financial statements to make decisions regarding a business or a person. Even personally, if you go buy a house or a car, the first thing they do is run a credit check. And really, that credit check is looking at your financial statements, how you're doing financially to see if you can afford that house or afford that car to be able to pay it. In accounting, there is an equation called the accounting equation. It's also called the balance sheet equation. This is artwork from Tom Friedman. It really reminds me of what the accounting equation is all about. That's a tightrope walker, and he's using that stick to make sure he stays balanced on the rope that he's walking on. And it's a good metaphor for the accounting equation, which is assets, things you own, liabilities, things you owe, and stockholders' equity, which is the difference between assets and liabilities. Assets are things you own, and liabilities are the things that you owe. So if you don't want to get caught up in long definition, just remember that. Assets are things you own, liabilities are things you owe, and stockholders' equity is the difference between the two. Now, there's this whole thing about balancing the accounting equation. This is very key and important in the accounting world. You always got to make sure that this accounting equation is balanced. For example, if assets were 100,000 and liabilities were 60,000, then you just have to find what stockholders' equity is to ensure that the accounting equation is balanced. I know it's simple math here because I'm trying to tell you that accounting is not hard math. Accounting is a language. Here, what is stockholders' equity? Well, if you know the assets, things that you own, are 100,000 and liabilities, things that you owe, are 60,000, then stockholders' equity is going to be 40,000. Let's do another example. Let's say what you owe or liabilities is 200,000, and stockholders' equity, also known as owner's equity, by the way, is 100,000. Then the question would ask, well, what are the assets? The assets equals liabilities plus stockholders' equity. So 300,000 is your assets because 200 plus 100 is 300,000. I know, basic math, I got you. But let's do a couple more examples. Let's say stockholders' equity or owner's equity is 600,000. And assets, the things that you own, is $1 million. So the things that you own is $1 million, and your stockholders' equity is 600,000. The question that you may be asked is, what are liabilities? I know, seems like a little bit of algebra. Yes, you are finding the missing variable, but liabilities is 400,000 because 400 plus 600 equals $1 million. So, to sum up this entire slide, you must always make sure that the accounting equation, which is assets equals liabilities plus stockholders' equity, is in balance. Now, let's get into the accounting equation. Again, it's referred to as the balance sheet equation a little bit more. Remember, it's assets equals liabilities plus stockholders' equity. Assets are things you own, liabilities are things you owe, and the difference between the two is considered stockholders' equity, also called owner's equity. Now we can expand this equation, all right? And when you expand this equation, it breaks up into the different classifications in accounting. You still have your assets on the left side of the equal sign. You still have the liabilities on the right side. So assets equals liabilities. But the stockholders' equity or owner's equity portion of the equation can be broken out or expanded into 4 different components. The first component is capital, owner's capital or capital stock. The second component is dividends. It's also called drawing. The third component is revenues. And the last component is expenses. So again, that is considered the expanded accounting equation when you expand stockholders' equity into 4 pieces. The first one's capital stock. Second one is dividends. Third one is revenues. And the fourth piece is expenses. Those 4 things. Now, depending on the type of business, capital stock is usually for a corporation, but for sole proprietorships, it'll just be considered capital. Dividends is for also corporations. For sole proprietorship, it'll be referred to as drawing. So let's review the definitions. Assets are things that you own. Liabilities are things that you owe. Capital stock is what the owner puts into the business, or capital. Again, capital stock is the same thing. So what owners put into the business, or what they give the business itself. Dividends or drawing is opposite of capital. Dividends or drawing is when the owner receives something back from the business, whether it be money or stocks. They get something back. So capital and dividends, or also known as drawing, are opposite one another. Revenues, this is a key point here. Revenues is when the business provides its goods or services. So anytime the business provides its service or goods, it doesn't matter whether they receive cash now or later, you're still going to record revenues when the business actually provides their goods or services to customers. Now, expenses, there's a lot of expenses because expenses is the cost to do business. And there's a lot of cost to run a business. So any cost related to running a business is considered expenses. Please go over those definitions, make sure they're clear, because it's really important when we analyze transactions. So we're going to go back to balancing the equation. And it's the same thing that we were doing in the previous slide. But this time, this equation is expanded. What specifically is expanded? The stockholders' equity section. So let's say assets were $100,000. And our revenues, when we provide our goods or services, is worth $100,000. Here you can clearly see that your assets equals the same thing on the other side, which in this case, more specifically, is revenues at 100,000. Let's get into another example. Again, let's say assets, things that you own, is 100,000. Your dividends or drawing is 100,000. Here, if you notice, the accounting equation is not balanced. I wanted to give an example where it wasn't balanced because you have a positive 100,000 on the left side of the equal sign. And then on the other side, you have actually a negative 100,000. Because if you look at the accounting equation, there is a minus sign in front of the dividends or drawing. So that minus sign will make that 100,000 automatically a minus or a negative number. And that's why our accounting equation did not balance. Now let's say that the 100,000 is at capital stock or capital. Well, it's a positive on the left side and a positive on the right side of 100,000 each. So now your accounting equation is balanced. Let's do another example. Again, things that you own, let's say that you have 100,000. And you have another transaction that decreases the things that you own for an equal 100,000, but this time it's negative. In these cases, you have a net effect of 0. The right side, nothing happens, so that's also 0. And still your accounting equation balances. This is a really good example where things are going on only on the left side and nothing goes on the right side, but you're still balanced. Let's go to our last example. So let's say assets, you have negative 100,000 and dividends or drawing is 100,000. This is actually balanced because as mentioned earlier, in the accounting equation, there's a minus sign in front of the dividends and drawing, which makes that 100,000 a negative number. So on the left side, you have negative 100,000, and on the right side, you also have a negative 100,000 because in the equation, that makes that amount automatically a negative. So our accounting equation continues to be or is balanced. Hopefully that makes sense. It does take a lot of practice. Please let me know if you should have any questions at all on the accounting equation or the expanded accounting equation. Here it's really important to remember that in the expanded stockholders' equity, the components have a positive sign, a negative sign, a positive sign, and a negative sign, which will affect your amounts. So when we're talking about that positive sign, let's say for capital stock, that increases stockholders' equity. For dividends or drawing, that minus sign implies that dividends or drawing decreases stockholders' equity. For revenues has a plus sign, so revenues will always increase stockholders' equity. Finally, expenses has a negative sign in front of it, and that implies that any expense transaction will decrease stockholders' equity. It's just language that we got to get familiar with. All right, next, we're going to talk about accounts and classifications. This is very key right here. And the more you understand it, the better you'll be at analyzing transactions. Here, which are classified as fruits and which are classified as vegetables. I hope you can do this. Let's do it together. The watermelon. Well, the watermelon is an example of a fruit, so that's classified as a fruit. The pumpkin is the next one. That is classified as a vegetable. So these are examples of different types of things, and our main goal right now is to classify. The tomato, well, that is classified as a vegetable. The banana is the next one. That is classified as a fruit. Pineapple is the next one. That is classified as also a fruit. Broccoli, one of my faves, that is classified as a vegetable. The next one is a kiwi. The kiwi is classified as a fruit. And lastly, we have a carrot, and that is classified as a vegetable. You see what we did there? We had different examples of things, and all we did was classify them, and in this case, between a fruit or a vegetable. In accounting, it's the same thing. It is the same thing, and the more that you could wrap your minds around it, the better you'll be at analyzing and recording transactions. Our classifications in accounting is the expanded accounting formula. Again, our opening example, our classifications were fruits and vegetables. So we had examples, and those examples we were just classifying, right? So in accounting, those examples are actually called accounts. I'm going to repeat. The examples that we were classifying are called accounts in accounting. Now, bear with me now. So, what are examples of classifications? As I stated just moments ago, your classifications are assets, liabilities, capital stock or capital, dividends or drawing, revenues, expense. So those are your classifications. Up there, we only had 2 classifications in our example, but in accounting, we have 6 types of classifications. And we have examples of accounts. Those accounts are the fruits and vegetables we were talking about, just metaphorically speaking. These examples of accounts, I'm going to go over some. These take practice, but the more you familiarize yourself with them, the easier and faster you'll be at analyzing and recording transactions. So, our first example of an asset is cash. Accounts receivables. Cash is cash. Accounts receivables is an account that implies it's money that you will receive in the future. Accounts receivables. We'll get into it some more. Supplies, computer. And remember, these things are things that you own, okay? Equipment, land, vehicles that the business may own. So all these are examples of assets, and these are referred to as accounts. And what are they classified as? Assets. Now, liabilities, most of the time, they end with the word payable. So liabilities are things that you owe. The accounts of liabilities are accounts payable, wages payable, notes payable, bonds payable. These are things that you're going to pay out in the future because you owe them. Dividends payable is another one. Lots of payables. So if you owe someone or an entity money in the future, it is a payable and it is classified as a liability. Another big one is federal income tax payable. Your business is making lots of money, it makes net income, and the government will want to tax you on that net income. All right, what account are examples of capital stock? Well, if it's a corporation, you'll have what's called common stock or preferred stock, which we'll get into later in the chapters. That's a little bit later down the line. Normally, it's called owner's capital. So the owner's name and the word capital. Remember, capital is when the owner puts into the business or gives to the business. Dividends or drawing, examples of those are stock dividends or cash dividends. If it's a sole proprietorship, it's the owner's name, comma, drawing. And remember, dividends or drawing is when the owner gets something back from the business. All right, what type of accounts do we have for revenues? This is a tricky one, but remember the key words. Remember, it's a language class, not really a math class. The first major account is fees earned. That's when you provide a service. In reality, any account that has the word fees is usually a revenue account, or the word revenue itself can be used. When we get into merchandising business or merchandiser, the revenue account there is sales. Lastly, we have expenses, and expenses has the longest list of accounts, and it tells there's a hint that it's an expense account or classified as an expense account because the account name will end with the word expense. So for example, I wrote here rent expense, advertising expense, utilities expense, wage expense, supplies expense. Anytime an account name ends with an expense, it is classified as an expense. Last one, miscellaneous expense. Again, lots of expense accounts. So you have a bunch of accounts. It takes, and I realize that it will take a while, some practice, lots of practice to get familiarize yourself with those accounts. And you got to be able to classify those accounts. Let's now get into business transactions. We'll do a bunch of examples so you start to get comfortable with the accounting formula. Here we have Royce Angelo invested $50,000 into his consulting business. It's important to note that it's a sole proprietorship. He goes to the bank and transfers the money from his personal account to his business's bank account. Remember that accounting, in this case, is for the business. So you, the accountant, is accounting for the business and not necessarily for the owner's personal money. In this case, it's Royce Angelo. So you're only thinking about the business. Right now, the account that's affected in this transaction is cash. So that's the account because the business is receiving cash and the business owns the cash. So you're going to record $50,000 on the asset side, more specifically the cash account, which is classified as an asset because now the business owns that cash after its owner, Royce Angelo, put money into the business. And then on the right side, you want to record stock, capital stock. Here, it actually should say owner's capital of 50,000. So sorry for the mistake there. It says stock, but it should say owner's capital of 50,000. Here, the accounting equation is now in balance. So you record cash and you record capital for $50,000 each. 50,000 equals 50,000. The accounting equation is in balance. On May 2nd, Royce cut a check or wrote a check for $4,000 to pay for rent for the space his business occupies. So here he paid $4,000 for rent. So what accounts got affected? Well, the business's cash got affected by $4,000. And in fact, that cash went down. So that $4,000 is a minus because again, he's paying for something. And in this case, he's paying for rent. And because that's the cost that's related to the normal operations of the business, cost meaning specifically the rent, that account or the account that's affected is called rent expense, so of $4,000. And because that's a minus right there, you have to put a negative in front of that $4,000. So here our accounting equation balances, minus 4,000 on the left side of the equation and minus 4,000 on the right side of the equation. That's important to note there because we had a $4,000 amount on the expense, but since the expense had a negative in front of it, it becomes a negative amount. Here, Royce purchased $1,500 worth of supplies on account. This is a term there that I underlined because it's a term that you must get used to. Again, accounting is like learning a new language. So when you see that term on account, it implies either two accounts. This is important here. It's either going to mean that it's accounts payable or accounts receivables. Okay, so when you see that term on account, it's either going to be one of those two accounts. Accounts payable is what you expect to pay in the future. Again, expect to pay in the future. That means you owe. Okay, accounts receivables is you expect to receive money in the future. Expect to receive. So you own the right to receive money in the future, usually from customers. Well, in this case, because he purchased supplies of $1,500, it's going to be accounts payable because he purchased supplies and now he owes someone, a supplier or a vendor, $1,500 for those supplies. So the account in this case, when you see those words on account, you have to pick accounts payable because now he expects to owe or pay in the future. So he owes and expects to pay in the future. That's accounts payable, $1,500. And then you want to record supplies. He owns those supplies now. so that's $1,500 on the left side. Your accounting equation balances $1,500 on the left and $1,500 on the right. And they're both positive numbers. Why is accounts payable positive? Because his expectation to pay just went up after he got those supplies. Next, Royce purchased $3,000, a $3,000 computer. He paid cash up front, and then the rest is on account. And there again, you see the word on account. So he bought a $3,000 computer. He owns that computer now, so that computer is classified as an asset. So computer is worth $3,000. He paid cash, and cash is an account, and that account is also classified as an asset. And the cash amount goes down by $2,000 because he paid up $2,000, or the business did. And if you notice right there, real quickly, you have an increase of $3,000 on things that you own and a decrease of $2,000 of something you own. The net effect is $1,000 on the left side of the equation. Now let's look at the rest of the transaction. It says on account. Remember, it's either accounts payable or accounts receivable. In this case, he owes, and owing is a liability, so accounts payable is the account, and again classified as a liability. How much does he owe? $1,000. So $1,000 equals $1,000. Our accounting equation is in balance. If I'm going too fast, don't worry. Pause the video, take all the information, and again, all this takes a lot of practice to get used to. All right, next example was consulted client Taryn Alyssa. So she's a customer. She paid Royce $800 for services rendered. Rendered means provided, so if you see that word, it really just means the business provided its services. Well, Taryn paid Royce cash. How much? $800. So cash is classified as an asset. So we have $800 on the left side. And what is it for? Well, it's for services rendered. That means Royce provided Taryn services. Here it's consulting. So we're going to get real specific. We're going to call it consulting fees. That's the account, and it's classified as a revenue. There it is. The business cash increased by $800. The right side also increased by $800 because it's services provided, and your accounting equation balances. All right, our next example is on May 13th. On May 13th, Royce provided services worth $600 on account to client Braylon Antonia. Remember, on account implies either it's accounts payable or accounts receivable. Accounts payable is the expectation to pay in the future. Accounts receivable is the expectation to receive money in the future. And because Royce is providing services to Braylon, you know it's accounts receivable because he will expect to receive money from Braylon in the near future. So it is accounts receivable and not accounts payable. That's an example where on account, that term can imply two different types of accounts. In this case, it's accounts receivables, and Royce owns the right to receive that money in the future. So that's going to be classified as an asset. So again, the accounts receivable account is classified as an asset. How much is he going to expect to receive in the future? $600. Well, he provided services, and more specifically, it's consulting services, so we'll call that consulting fees for $600. That's a positive sign. That's a positive on the left side, so your accounting equation balances. Remember, we're the business, so the word fees is actually a good thing because we're charging customers fees. Get in the habit of thinking from the business's point of view, okay? Because you are the accountant in this class for the business. Here, Royce provided services worth $900 to client Xavier Chase. Xavier paid Royce $500 in cash and will pay the balance in the near future. Another example of where Royce provides services, so let's record that. The account related to that is consulting fees, and it's classified as a revenue account because he provided services. It's worth $800. Xavier, the customer, paid some of that amount, okay? And when the customer paid cash of $500, so the cash went up $500. The rest the business will expect in the future. So the expectation to receive money in the future is considered accounts receivables. And the expectation to receive money in the future just went up $400. Consulting fees were $900. Cash went up $500. And accounts receivable, the expectation to receive money in the future just went up $400. So on the left side of the equation, you add 5 plus 4, which will give you the $900. That will equal the positive amount on the other side of also $900. So your accounting equation stays in balance. Next example. Royce receives a $600 check from client Braylon Antonio for previously provided services. This is important here. Royce received money, and that's cash. So cash went up $600. Here it's a little bit tricky. You'd think that you'd want to record consulting fees, which is revenue. But no, you're not going to record consulting fees here because you did that in the past. Okay, because it says previously provided services. Instead, he was expecting that money. Okay, and that money came in. So what we're going to do is we're going to decrease the expectation to receive money. Which account is that? That's the accounts receivable account, which is also an asset. So the expectation to receive goes down by 600. So 600 went up on the asset side and 600 went down also on the asset side. This will affect, the net effect is 0, and your accounting equation will still be in balance. I hope that makes sense. Let's go to the next example. Royce pays his part-time receptionist $750. I mean, anytime you see the word paid or pays, you know that it will deal with cash. Cash is classified as an asset. The asset went down by $750 because the business is paying the receptionist, okay? And because it's a normal cost of business to pay your employees, that's considered an expense. Let's assume this part-time receptionist gets paid hourly. The account is going to be called wage expense. So you have a negative $750 on the left side and $750 on the right side, but in the accounting equation, there's a negative in front of that E, so naturally it makes it also a negative. And you will have the accounting equation still in balance. Next example, Royce pays $200 for advertisement on the internet. So he's advertising his business on the internet. He pays $200. That's another word again, pays. So pays implies usually cash. Your cash is going down by $200 because you're paying someone for something. In this case, it's advertisement. Advertisement is another cost, a normal cost of business. So this is going to be called advertising expense. And the amount for that is $200. And because expense has a negative in front of it, the $200 also becomes negative. So negative 200 on the left side equals a negative $200 on the right side. The next example is coming up. Here it is. Royce goes to the bank and withdraws $100 from his business's bank account. I know I've been saying he pays, he does this and all that, but in reality, we are the business. The accountant is the business and keeping track of business transactions. So what did he withdraw? Well, cash. So the business's cash goes down by $100. We're not keeping track of his money. We're keeping track of the business's money. So I apologize if I kept saying he pays or he did this. But in reality, he represents a business. It's a sole proprietorship. So all those transactions is dealing with the business. And anytime the business gives back to the owner, it's considered dividends or drawing. Dividends for a corporation, drawing for a sole proprietorship. So your cash is negative $100 on the left side, and the dividends or drawing is $100. And there's a natural negative sign there, so your accounting equation is still in balance. I know this is a lot for the first lecture. Just take the time to practice, look over transactions and examples of transactions, and see if you can balance the accounting equation. The last topic of this part 1 video is financial statements. We're going to do a quick overview because we'll discuss this more in detail in another video. Real quickly, there are 4 financial statements. and you have to do it in this order. First, you have to create the income statement, and you create the statement of retained earnings, which is also called the owner's equity statement. Then you create what's called a balance sheet, and then finally you create a cash flow statement or statement of cash flows. Those are the four different financial statements. That really is the end goal of accounting. You must provide the financial statements to people that need to make important decisions. Here's another way to look at financial statements. I created these charts here. The accounting equation, the expanded accounting equation, is actually the financial statements. If you really take a look at it, and I made another picture there at the bottom, A equals L plus C minus D plus R minus E. Because in reality, when you create the income statement, okay, the first thing, if you look at that top picture, the first financial statement you make is the income statement. The income statement is R minus E. That's the general formula, revenues minus expenses. The second financial statement is the statement of retained earnings, and there you take the net effect of the income statement and you combine it with the dividends or drawing. So R minus E minus D, and that will give you your retained earnings statement. The third financial statement is your balance sheet. In your balance sheet, you just make sure A equals L plus C, and then the rest of it, minus D plus R minus E. If that was too much for you, it's okay. It's okay. But if you see the relationship there, you're ahead of the game. Additional topics to review that I did not cover in this lecture that you should review on your own is the nature of business and the role of accounting and ethics in business. So make sure to please read that in the textbook or do research on that on the internet. Also describe generally accepted accounting principles, including underlying assumptions and principles. So here it's really the rules of accounting. I know I didn't get into it in this video, but please review that on your own because some of those questions might show up on your first exam. Thank you guys. Thank you for hanging in there for around 37 minutes. Again, if you guys should have any questions, please feel free to contact me, ask a classmate, do research on the internet, look in the textbook. Thank you for listening, guys.